Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, imagine waking up tomorrow and finding out that a single blocked waterway on the complete opposite side of the planet has just totally quadrupled the price of the fertilizer used to grow your morning oatmeal.
It sounds like a movie plot.
Right. And on top of that, it forced a country of 170 million people into total darkness. And it's actively rewriting the strategy for your 401k. I mean, it's crazy.
It really is. But that is the exact reality we're looking at right now. Based on the latest macroeconomic reports, we are tracking what analysts are calling a global energy domino effect.
The domino effect.
Exactly. And the single most crucial thing to understand about the data we're looking at is that energy touches absolutely everything. I mean, there is not a single aspect of the modern physical world that operates independent of energy costs.
Which is our exact mission for today's deep dive. We are going to decode this massive, complex web, and we're going to do it without all the confusing Wall Street jargon, because the goal is to help you, the listener, understand exactly how these distant global dominoes eventually crash right into your wallet and your daily life.
Yeah, that's the key.
So, to get our bearings, I think we have to start with the big picture, right? The one provided by the International Monetary Fund.
Right. So looking at the recent analysis, the IMF has basically flipped all of its dashboard warning lights to red.
Wow, all of them.
Pretty much, yeah. Recent data shows that Brent crude oil, which is the major global benchmark for oil prices, it jumped over 50% in a single month.
Wait, 50% in 1 month? That is staggering.
It's massive. And because of this, the IMF is warning of three distinct, deeply interconnected risks. We're talking about persistently high inflation, significantly slower global economic growth, and severe financial market stress.
Okay, so inflation, slower growth, and financial stress. That's a really rough combination.
It is. And the analysis we're looking at provides a really interesting rule of thumb from the IMF to help us kind of measure the damage.
Oh, yeah, the 10% rule.
Exactly.
Yeah.
The rule states that if global energy prices jump just 10% and they stay at that level for a year, global inflation rises by 0.4 percentage points and total global economic output drops by 0.1 to 0.2%.
Okay, let's unpack this, because it feels like trying to comprehend a citywide power outage.
That's a great way to put it.
Yeah, because it's not just about sitting in the dark in your living room. It's the cascading failure. Like, without power, the municipal water pumps fail. And when the water pumps fail, the hospitals can't sanitize their surgical equipment. So one foundational failure triggers a dozen completely unrelated crises.
The cascading failure is the perfect analogy. Economists actually call these second-order effects.
Second-order effects, got it.
Right. What's fascinating here is that when crude oil spikes, people immediately think about the price of gasoline for their daily commute. But crude oil and natural gas are the foundational building blocks for almost the entire global supply chain.
Like agriculture, right?
Exactly. Agriculture is a huge one.
Yeah.
Natural gas isn't just used to power the factories that make fertilizer. It actually provides the physical hydrogen molecules required to synthesize ammonia.
Wait, really? It's literally in the fertilizer?
It is the literal raw material. So when natural gas prices spike, the physical cost of creating nitrogen fertilizers just skyrockets.
Man, which means farmers either plant fewer crops or they have to pay double to grow the exact same amount of food.
Yeah, which obviously drives up global food costs.
And I'm guessing at the exact same time, the diesel fuel powering the cargo ships and the freight trains that are, transporting that food across the ocean, that doubles in price too.
You nailed it. By the time a simple box of cereal hits the shelf at your local grocery store, an energy premium has been baked into the price at the manufacturing level, the agricultural level, and the shipping level.
It compounds at every single step.
Exactly. It compounds.
I do want to push on that third risk the IMF mentioned, though. I think I understand how expensive oil causes inflation and, makes the cereal more expensive. But how does a jump in crude oil actually create financial stress? Like, how does it cause panic in the stock market?
Well, it really comes down to how central banks are forced to react.
Okay.
So when everyday necessities like food and manufactured goods become this expensive, inflation runs dangerously hot. And to fight that inflation, central banks, like the Federal Reserve here in the U.S., they raise interest rates.
Right.
They make borrowing money significantly more expensive to kind of cool down consumer spending and slow the whole economy down.
Wait, so by raising interest rates, they are intentionally making it harder for businesses to get loans to expand and like
Mhm.
harder for everyday people to get mortgages.
Yes, that's exactly what they're doing. But here is the mechanism that creates the global financial stress. When the U.S. Federal Reserve raises interest rates, U.S. Treasury bonds suddenly start paying a really attractive guaranteed yield.
Okay, so the safe money gets a better return?
Right. So if you are a massive global investor, you suddenly have a choice. You can keep your money invested in an emerging, developing economy, which, carries a lot of risk, or you can pull your money out and just park it in U.S. dollars.
Oh, wow.
Yeah, you get a high risk-free return backed by the United States government.
So the investors obviously take the safe bet. They sell off all their riskier international assets and flee to the safety of the US dollar,
Exactly.
which means the countries losing that investment capital are going to feel the pain first and worst, right?
That is exactly right.
Yes.
If we look at the data, it leads us directly to the most vivid real-world example happening right now, which is Bangladesh.
Yeah, Bangladesh. The research really highlights them as the ultimate canary in the coal mine right now.
They really are. The rapid withdrawal of global capital, combined with soaring energy costs globally, is exposing massive vulnerabilities for them.
Let's look at the numbers because they are pretty intense. According to the research, Bangladesh is desperately seeking over $2 billion in emergency loans.
$2 billion.
Yeah, they're looking for roughly $1.3 billion from the IMF and anywhere from $750 million to $1 billion from the Asian Development Bank. And the underlying reason is just wild Bangladesh imports 95% of its energy.
95%. Think about that.
It's basically all of it.
Oh, wow.
Because prices have spiked globally, they literally cannot afford the fuel to run their power plants. And the data shows they are already resorting to rolling blackouts and fuel rationing.
Right? It's a dire situation.
But I have to ask, wait, $2 billion just to buy fuel? If energy is more expensive globally, why doesn't the government just raise the electricity rates for their citizens to cover the costs? Like, why take on billions in international debt just to keep the lights on?
Because of the immediate threat of severe social unrest. Oh. Yeah. When you are dealing with a developing nation, you cannot simply double or triple the cost of electricity overnight. The population physically cannot absorb that cost.
They just don't have the money.
Exactly. And if a government tries to force it anyway, people take to the streets. The government is leaning heavily on massive international debt as a desperate measure just to maintain basic social stability.
Man, that makes me think of an everyday American family living paycheck to paycheck,
Yeah, absolutely.
Suddenly, the price of gas to commute to work just doubles. They don't have the extra cash in their checking account, so they start putting all their groceries and their gas on a high-interest credit card just to survive the month.
Right.
But then the next month, gas is still double, and now they have a massive credit card bill to pay too. They are borrowing expensive money just to maintain their baseline existence. They aren't building anything new or investing in their future.
That is a perfect parallel. If we connect this to the bigger picture, for anyone looking at global investments right now, this situation completely shifts the paradigm of how you evaluate risk.
How so?
Well, in the past, investors primarily looked at a country's GDP growth. If the economy was growing, it was considered a relatively safe bet. But in an era of sudden energy shocks, looking at GDP is entirely insufficient. You actually have to look at a nation's foreign exchange reserves.
Which is basically their national savings account of foreign currency, like US dollars, right?
Right.
The money they use to buy imports from the rest of the world.
Yes, exactly. Because vital commodities like oil and natural gas are priced in US dollars on the global market.
Oh, right.
So if a country doesn't produce its own energy, it is completely at the mercy of global supply chains. When the dominoes start falling, nations without a domestic energy buffer are forced to burn through their dollar reserves at terrifying speeds.
And once that's gone.
Once those reserves dry up, they have to beg international organizations for bailouts just to keep their citizens from freezing or sitting in the dark. It transforms what should be, a localized energy problem into a full-blown sovereign debt crisis.
And when a sovereign government has to borrow billions just to avoid rolling blackouts, it sends a very clear, very dangerous signal to the people living there. I mean, the public isn't blind. They see the rationing happening.
Oh, absolutely.
And the second people sniff out a potential shortage, the panic buying starts at the street level.
It does. Human psychology is incredibly predictable when confronted with the fear of absolute scarcity. Rational behavior just disappears almost instantly.
Yeah, the reports we're analyzing detail this beautifully. Here's where it gets really interesting. In Sri Lanka, massive, chaotic lines formed at gas stations nationwide. And this happened despite the government going on television and explicitly assuring the public that there was ample supply.
People just don't believe it.
Right. Over in Australia, local fuel demand literally doubled overnight in certain regions. It forced the Prime Minister to publicly beg citizens to stop hoarding fuel.
Wow.
In Cambodia, a third of the gas stations completely shut down because the regional supply chains simply broke under the sudden strain. And, here at home in the U.S., gas is hovering right around $4 a gallon, which is causing plenty of anxiety at the pump.
Yeah, $4 is a psychological threshold for a lot of people.
Definitely. And listening to this consumer reaction, I can't help but think about the infamous great toilet paper run of 2020.
Oh, man, yeah.
People saw one empty shelf, panicked, bought a year's supply, and that very fear actually created the shortage they were terrified of in the first place.
Exactly. The consumer panic is one major element for sure.
Yeah.
People topping off their tanks every single day out of fear certainly strains local distribution. But there is a second type of panic detailed in the data that is far more dangerous to the global economy.
Okay, what's that?
Systemic hub stress.
Ah, you're talking about the data point from Singapore.
Yes. So Singapore acts as the major pricing and distribution hub for all of Asia. And the data shows that jet fuel prices there skyrocketed 140% to a record $225.44 a barrel.
That's insane.
It is. And this isn't everyday people filling up their sedans, right? This is international airlines and massive logistics companies fighting over the raw materials they absolutely need to operate their businesses.
So it's commercial panic buying. It's like every bakery and restaurant in a major city buying up a year's worth of flour at a 300% markup just because they heard a rumor on the news about a global wheat shortage.
Yes.
They are locking in terrible prices out of pure fear.
And in economics, panic buying on a commercial scale triggers a massive bullwhip effect. It artificially spikes demand in the short term, sending a false signal to the entire market that the world needs twice as much fuel as it actually does.
Oh, I see.
So airlines lock in these massive futures contracts at $225 a barrel, absolutely destroying their profit margins for the next 2 years.
Wait, what happens after that initial spike, though? Because they can't keep buying at that rate forever, right?
No, they can't. What follows is a massive, painful crash. Once an airline has filled all its reserve tanks at those exorbitant prices, or a distribution hub is completely stockpiled, they stop buying completely for weeks or even months.
Because they're already full.
Right. Real demand plummets to near zero. And this extreme volatility whipsaws the financial markets. Going back to your bakery analogy, the bakeries go bankrupt from the massive flour bill before they even bake a loaf of bread.
Man. Smaller distributors fold, logistics companies default on their loans, and the supply chain breaks even further.
Exactly.
So if consumers are hoarding gas and commercial airlines are bankrupting themselves with panic buying, the authorities have to step in. Which brings us to the global policy reaction.
Right.
The analysis notes that the International Energy Agency, the IEA, stepped in and facilitated a record-breaking 400 million barrel release of oil from global emergency reserves.
Which is huge.
It is. And just to put the geography into context for you, the vital Strait of Hormuz is currently blocked. That is a maritime choke point that normally handles 20% of all global oil and liquefied natural gas.
20% is a massive chunk of the global supply.
Yeah. Because of that blockage, the U.S. has also stepped in, loaning out over 45 million barrels from our own strategic petroleum reserve.
Now, on paper, a 400 million barrel release sounds like an overwhelming show of force by global authorities.
It does, until you actually do the math on global consumption.
Yep.
The underlying data reveals the catch. That historic, massive 400 million barrel release. It only covers about 20 days of the disrupted global supply.
20 days.
20 days, which completely explains why the IEA has moved past just releasing emergency oil and is now literally begging the public for drastic behavior changes.
Yeah, this part is wild.
They're asking people to telecommute to work, they're pleading with people to reduce their air travel, and they are officially asking drivers to go 10 kilometers per hour slower on the highways to improve fuel efficiency.
It is a profound shift in how these global energy agencies communicate with the public.
Honestly, I have to push back on this. Because as an everyday American, reading that the IEA wants us to drive slightly slower on the interstate to solve a historic global energy meltdown, it feels slightly ridiculous.
I tap that.
Right. Like, are we really going to solve an international supply chain crisis by asking commuters to ease off the gas pedal? It sounds like putting a tiny dollar store Band-Aid on a severely broken leg.
This raises an important question,
Yeah,
and you are entirely right to be skeptical. It absolutely is a Band-Aid.
thank you.
But the fact that an agency as powerful as the IEA is suggesting it highlights a terrifying underlying reality. Traditional market interventions are no longer working. Releasing strategic reserves and trying to control prices simply isn't enough to plug the hole anymore.
Because it's a physical problem.
Exactly. When the physical supply of energy is fundamentally broken, whether by a block strait, a war, or a supply chain collapse, you cannot magically print more oil or natural gas.
Right, because it's a physical commodity, not a digital currency.
Exactly. The only mathematical fix to balance the market when supply drops that drastically is to force demand to drop just as fast. Economists call this demand destruction.
Demand destruction? I mean, that sounds incredibly ominous. What does that actually look like for the person listening to this?
So demand destruction means the market makes a commodity so outrageously expensive or physically restricts it so heavily that everyday people are quite literally forced to change how they live.
Oh, wow.
Yeah. The IEA asking you politely to drive slower is the voluntary version of demand destruction. The involuntary version is gas hitting $8 or $9 a gallon, forcing you to cancel your family vacation because you literally cannot afford the fuel. The system forces you to consume less by inflicting severe financial pain until the market balances out.
Wow, that puts it in a very stark perspective. We are talking about an era where the market is actively trying to price everyday people out of participating in the economy.
Unfortunately, yes.
Which brings us to the ultimate question, bringing all of these massive global concepts right back home. We've covered the falling dominoes from the IMF warnings, the massive capital flight draining Bangladesh, the commercial panic buying in Singapore, and the reality of forced demand destruction.
We've covered a lot of ground.
We have. So if you are a beginner investor here in America trying to navigate your portfolio under the current Trump administration, what do you actually do with this information?
Well, the instinct for most beginner investors when they see headlines about an energy crisis is to say, oh, oil prices are up, I should just buy stock in oil drilling companies.
Right. That seems like the logical first step.
But you have to look past the obvious headlines. The analysis shows that the real economic pain, and therefore the real market movement, isn't just in raw crude oil. The acute, long-term stress is happening in refined products, diesel, jet fuel, agricultural fertilizers, and maritime shipping.
Oh, interesting.
Yeah, this crisis is fundamentally forcing a rewrite of what institutional investors call the energy security premium.
So what does this all mean? If I'm looking at my 401k or my brokerage account today, I need to broaden my lens.
Absolutely.
It's not just about who pulls the oil out of the ground. It's about looking at the logistics companies that actually transport the goods. It's about looking at massive agricultural businesses that are figuring out how to innovate around these exploding fertilizer costs. And crucially, it's about utilities.
Yes. Utilities are a fascinating sector in this environment. You have to look at utility companies that have the pricing power to successfully pass these increased energy costs onto consumers without going bankrupt themselves.
Wait, how does a utility company just pass on the cost? If their costs double, don't they lose money?
Not if they operate as a regulated monopoly, which many major utilities actually do.
Oh, but right.
When their fuel costs double, they go to a state public utility commission, present their open books, and request a rate hike. And because they provide an essential service like electricity or water, the commission generally approves the hike.
Wow, so they're protected.
Exactly. The utility protects its profit margin and its dividend payout, while the consumer absorbs the financial pain. In an era of demand destruction, companies that can legally pass their costs downstream are incredibly resilient.
That is a phenomenal mechanism to understand. So to synthesize everything we've covered today, we have to realize that this current global crisis is not a temporary blip.
No.
It's not a short-term market fluctuation that is going to magically resolve itself in a month when a shipping lane clears. This is a structural, foundational shift that is going to dictate market trends for the rest of the decade.
Very true.
And under the current Trump administration, we hear a lot of talk about energy independence. But this data shows it's no longer just a catchy political talking point for campaign trails.
No, it is a matter of profound national security. And it represents a massive generational investment cycle. Nations all over the world are waking up to the terrifying reality that relying on fragile, stretched-out global supply chains for their most basic energy needs is an unacceptable liability.
So they're pivoting.
So they are pivoting hard.
Which means we are going to see historic, multi-trillion-dollar pushes toward alternative and domestic energy. We are talking about the rapid expansion of nuclear power, massive overhauls of aging domestic electrical grids, and huge investments in liquefied natural gas or LNG infrastructure to replace reliance on foreign pipelines.
Countries and companies that can successfully control their own energy destinies, insulated from the chaos of global bottlenecks and international capital flight, they are going to carry a massive premium in the stock market going forward.
That makes total sense.
They will be the absolute safest bets in a highly volatile, unpredictable world.
It really forces you to look at the globe entirely differently. Every time you turn on a light switch, buy a gallon of milk, or check your retirement account, you are participating in this incredible, fragile global web.
Everything is connected.
And understanding the mechanics of that web, knowing why the dominoes fall, is the absolute key to protecting your wealth and making smart, informed decisions in this new economic reality.
The dominoes are already falling. The only question is whether you position yourself to get knocked over by them or to capitalize on where they land.
Which leads me to one final, lingering question for you to ponder long after this deep dive is over. If a painful, chaotic global energy crisis forces a massive, permanent shift in consumer habits and supercharges a race for true domestic energy independence, could this terrifying domino effect actually be the exact catalyst the world needed to finally break free from its dangerous reliance on fragile, unpredictable global supply chains? Something to think about. Don't forget to subscribe and hit that like button.